Welcome to Money Matters. My name is Patty Tawadros, and my co-host today is Pat Dunn. And she works with the Dunn Group, which does wealth management at Merrill Lynch.
Yes,
welcome.
Thank you.
Yeah, so I'm not a finance expert, so you're going to forgive me for fumbling through some of these questions. But your first one is to talk to us about the equity markets. I know they were volatile last week, but they managed to make up some ground. Could you give us some insight as to why?
I'd be happy to. Please bear in mind, though, that this program is taped and shown at a later date, so my response may be dated.
Okay.
But for the week of December the 1st, 2015, we had 3 negative incidents that brought the market down and 1 positive that brought it back up. It was a very interesting week. We had, on the negative side, we had the ECB, the European Central Bank, continued its easing, but not as much as what was expected. And they also lowered interest rates only by 10 basis points, and the world expected a bigger rate cut.
Okay.
Then OPEC announced that they were going to keep oil production levels the same, and that led to lower energy prices. And then finally, we had a manufacturing report that was extremely weak, and that was very disappointing. Manufacturing is very important in this country. But then on the other hand, we turned around and we had a positive jobs report, which was very well received, and that led people to believe that the Fed might actually raise rates finally here in December.
And those are interest rates on bank accounts, CDs?
Correct.
Okay.
And that led the market higher.
But how does that impact mortgage rates?
It will make mortgage rates higher.
Okay.
Yes. So we'll be getting into that later.
Okay. All right. And the financial markets went through a number of issues in 2015, but it still managed to rebound.
Exactly. And what a surprise. Because when you think about it, we had actually 5 negative factors affecting the market in 2015, and you would have thought that the market would be down substantially. But as of the end of November, the S&P 500 was actually up 1.04, not setting any records at 1%, but given the fact that in 2015, manufacturing slowed, Chinese growth weakened, we had pervasive deflation concerns. They just would not go away. Commodity prices fell, which impacts a lot of things, and geopolitical risk only got worse. So you have to think to yourself, wait a minute, with 5 things like that, how can we look at a market that's actually up? It should be down when it's not.
It's a relief that it stayed up.
It's a relief that it stayed up, but I'm a very logical person, so what were the counterbalancing factors here? So I really looked hard for that, and we actually had 3.
Okay.
We had low inflation. We had decent, not terrific, but decent United States economy growth. And we had supportive monetary policy. So it's very interesting. One of my favorite gurus in the financial world is Sir John Templeton. And one of his phrases I have held throughout my 40-year career. He said that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And I think 2015 can be put down as a year that grew on skepticism.
Well, how does it look for 2016? Do you want to make any predictions?
Well, my predictions is as good as anybody else's, but for that I do lean on the economists. And what the economists are saying is actually quite positive. The economists feel that there is very low risk of a global recession.
That's a relief.
Very big
Especially
relief.
After everything that's happened that you said.
Yes. In fact, they say they see the world economy actually accelerating in 2016, not slowing down. That the United States economy will continue to grow, that the Eurozone will rebound.
What about Greece?
Well, Greece is such a small part, it really doesn't play on the world scale. What does play on the world scale is China.
Okay.
And they see China's growth stabilizing, which is a real improvement over 2015. So the macro things are in places, but also look at the micro, because historically when the Fed raises rates, within 12 months the market is typically up 10%.
So we could be looking at an uptick.
Uptick next year. And another positive factor is next year is a presidential election year. And historically, presidential election years are up years for the stock market. So, for what my crystal ball is worth, I think we're going to have a better year in 16 than we had in 15.
That's good to know.
Now,
Makes me feel relieved about investing and saving.
now to put the boots on the ground, Patty, you as a business owner.
Well, let me ask you a question first.
Sure.
We have a viewer question that's right in your wheelhouse from Tammy Robinson in media. And she asks, what are some tips to save money in your general financial spending? And I will tell you that that would be a question I would have too.
Very good. What I've found in my career are really two things that are really beneficial. Number one, the biggest mistake I see is people carry credit card debt at 16, 17, 18%, and then they'll have money in the bank because that's their savings. Now, for example, you could have $9,000 on a credit card balance, $5,000 sitting in the bank. This makes no sense at all. Take the $5,000 and pay down the credit card debt. And then, if at all possible, put the balance of it on a home equity line of credit. Why? Very simply. A bank account's going to pay minuscule amount, decimal 0.01%, which is taxable. Credit card is charging you 18, 19%, not tax deductible, but a home equity line of credit is tax deductible. So don't save money and carry a high balance. Wealth starts when you have no debt.
So just one clarification, though. You still want to have some sort of emergency fund, right?
Well, a credit card could be that emergency fund if you put, push
Pay it
came to
off.
pull.
Right.
But there makes no economic sense to have a savings account and have credit card debt.
That's good information, especially for the younger people graduating college with so much debt. And then we're always told, save, save, save. My mom's hounding me all the time. How much money's in your savings account? Are you saving? And, I don't have credit card debt, but I've been through those times, and that's good advice.
The second thing I would say is that since you asked about mortgages, and interest rates are going to go up, if not this month, maybe next month, but it's going to happen. If you haven't looked at refinancing your mortgage in the last 5 years, I would say do it now. Revisit that, because the rules have changed. The government has put out something called HARP, which helps people who have little to no equity in their homes to refinance. The banks have gotten much looser in who they will lend to.
Really?
Compared to what it was like in 08 and 09. And it's a situation where you have to grab the opportunity now before interest rates go up.
Have you looked at what the rates are like recently?
They're still quite low.
Around 4.
4, 3.
Yeah.
You know,
Well,
in
that's
that
good to
neighborhood.
know.
Yeah.
Yeah.
So that's really, I hope that answers Tammy's question.
I think it does. It answers my question from 10 years ago.
Well, let's switch gears, because Patty, you're a very successful business owner.
Thank
and,
you.
Xercel is in the technology area, and I love your brand that we design solutions for pixels and paper.
Yes.
And being of the paper generation, that makes my heart feel good. But as this American economy is growing, clearly the technology field is growing, but you're in a position to help other American companies to grow. So would you share with our viewers how you help them grow when it comes to things like social media?
Yeah, I think that there's a lot of factors involved, but one of the biggest ones is I have customers that say, oh, I don't go online, I don't need a Facebook page, I don't need to be on social media, but what they don't understand is their current customers if they're under 65, are on social media, and all their future customers are involved in social media. So you need to be where your customers are, because that's where they're communicating, that's where they're searching for reviews. They're using things like Yelp and Facebook and sharing products that they find online with their friends. So it's really important to get into that conversation, control the conversation, put out the information you want. So if you have a small local shop and you're running a special for the holidays, let's say, you want to be able to promote that, and you want to be able to run advertising campaigns that target people in your geographic area that are doing things. Let's say that they just purchased a home. You can use Facebook and you can tailor your ads to be delivered to people with buying behavior. So if they purchased a home, if they've searched for a car, if they're looking for home decorating supplies, all those kinds of things you can target, and you can take advantage of social media to deliver the content to them so that they find out about you.
Well, that's interesting, and that lends itself into mobility. Can you talk about how it's important for a website then to be involved in mobility?
There's something called responsive design. So their new thing happened with Google this year. They decided that anyone whose website was not considered mobile friendly, meaning, and there's two ways to look at mobile friendly. People will say, well, I open my iPad or my phone and I can look at a website and I just move it around on the screen to get to what I want. That's not considered mobile friendly. What's mobile friendly is when, do you ever see a website and it kind of collapses down into a bunch of tabs when you're navigating it on your phone?
Yes.
That's considered mobile friendly. It's called responsive design. So Google did this thing where they said if you don't use responsive design, your website will not rank it won't rank in search engine rankings, but that's only on a mobile device. So if someone's sitting on their computer at home and searching, they're going to find your company, but if they're on their phone or their tablet, they're not going to find your company before they find 25 other people doing the same thing. And the thing is that in 2014, we kind of crossed that tipping point where more people are using mobile devices to search the internet than they are using their desktop computers. So you really need to make sure that your website is up to date.
I never thought of that, because I do use Safari more on my phone than I do at home.
And is your website for your business mobile friendly?
I'll have to check.
Yeah.
I don't know.
And I know there's a lot of regulations around websites for the financial world. You can't give tips. You can't. There's a lot of information you can share, which is probably why you would think, I don't need to do that. I don't need to be involved in social media. I don't need to put a lot of effort into my website. But the reality is, people are looking online. People are giving recommendations to their friends for people to do wealth management, and those people that have wealth are coming up in this world, and they're younger, and that's how they're communicating.
Wonderful.
Yeah. But if you want to send your information into Money Matters, all you need to do is
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Okay, welcome back. And I want to introduce our guest today, which is Georgean Wardzinski from the Star Business Alliance. Thank you for being with us today.
Thank you for asking me to be here.
Yeah, and I know that the two of you are friends.
Yes.
Yeah. So you had a question. I think you're going to start us off.
Why don't you start by telling us what Star Business Alliance is and give us a good overview so our viewers know what your business is?
Well, Star Business Alliance brings expertise in the merger and acquisition business, basically looking at post-merger integration. We bring expertise in both the buy side and the sell side, in both publicly traded as well as private companies. We have worked in different industries, from financial services through healthcare, as well as professional services, and because of that we focus more on services, even though we have some manufacturing mergers that we've participated in as well. And we look to the fact that post-merger integration is one of the key things that a lot of time goes into the beginning of the process, the pre-assessment. And we have experience in both everything from pre-assessment through due diligence, through early and post-integration. But there's more energy that tends to go into a deal on the financial aspect on the early end, with less going into the operational end at the back end. And because of that, you find that in a 30-year trend, only about 20% of the acquisitions that occur actually meet the potential that they were anticipated to.
Only
20% after 30 years.
Wow.
So 80% don't meet the potential that is anticipated.
That's quite a disappointment for the seller, particularly.
Well, it's more the after the fact integration as to do they hit the marks that the person's planned as the buyer. The buyer goes in with an intent of we're going to either have some type of synergy or we're going to expand a market, and therefore at the end of that you're going to have improved operations, which then result to improved revenues, growth, and profits. And in many cases, there's so much work that's been done that then the effort's not put into either follow through on the operational side, and so they underperform in essence.
What is the current status of the merger and acquisition market?
Actually, as Pat was saying, it's been an interesting 15. Well, 2014 was a good M&A year, and 2015 people weren't sure, but it's on track right now, 2015, to actually beat out the year 2000 when there were .coms, and that was a big M&A year. And we're actually looking to 2016 as being another good year. Just like Pat was saying, the projections in the M&A market is for it to continue into 2016. And it's not just in the United States. There's actually a global merger boom happening, and mainly because as things that Pat talked about, low interest rates, the employment market is getting better, but because of that revenues were down, people were looking for other ways to get growth and value, and so they're going to both in the domestic as well as in the global markets trying to do acquisitions.
Do you see a trend in the types of businesses that are being acquired?
I think it's all over. I mean, from large corporate strategic acquisitions to mid-sized markets, and they break the mid-sized market down into low, medium, and high. And then you have people who are in the baby boomers who were looking in 08 to leave the market and liquidate their organizations, and then the bottom fell out. And now they're at the point where they're looking again, what am I going to do? Have I recouped enough to be able to liquidate and either retire if they've got their majority of their investment or their wealth in their business, or they're looking to maybe do another endeavor.
You know what's interesting? I heard from a woman that I view as a mentor that she sold her company, and a number of years later she wasn't satisfied with how they were running it, and she went and purchased it back from them, and now it's grown substantially.
I have actually heard that from a couple people that they didn't pay enough attention to. They looked at the financial front end and didn't look at how the people were going to be treated from the back end. And they were disappointed to see, because they spent so much time on the numbers aspect of it, and yet their heart and soul, because it was their business.
Yeah.
I'd like to capitalize on that, dig a little bit deeper. What would you suggest that private business owners do if they are considering selling their business so that they avoid some of these things?
I look at it in 5 different areas. Of course, the financials can be key, because remember, this is an investment strategy, whether it's a strategic in a larger organization or whether it could just be private equity or the personal investor. So people are looking at it from a money perspective. So you need to have a valuation done. And there are people that can actually value your company today and in line with whatever your intent is to get out of your business, value where you perceive and what time you feel you'll hit that value in the market for your company. So you need to get a valuation. You also need a strategy, and there are actually people who work in the financial world to do exit strategies and actually help you plan.
Do you do that?
I do not, but I work with exit. That's some of the people I work with are exit strategists.
And we do that.
And I was just going to say, Merrill Lynch does offer that. And do the exit strategy. And I'm sure Pat works with her people both from a business perspective as well as from a personal perspective. And it's really key, because long-term planning, you may want to sell today, but it may take you 3 to 5 years to get to the point that you can actually exit. So you need to determine when and how you're going to get there. And then you need to communicate with both your people financially in your organization and the key players, as well as personally, if it's got personal assets involved. And then after that, you need to implement the changes because, like I said, you may not be there today, and there may be specific things. For instance, on the smaller side, a lot of family-owned businesses don't have the infrastructure that will bring them the value when they're sold. So they may need to put in the infrastructure that they don't currently have in order to get the value that they want on the back end whenever they're selling or exiting the company. And then the last piece is the piece about the people, the person who rebought the company. You need to think about the people in your organization. They're the ones that got you to where you are. What are your concerns? How do you want that to happen? What are you going to do as far as people with intellectual knowledge or people that are part of your value of your business? You want to make sure they're there at the time that you exit because they may be the knowledge base and the key elements that you're selling in your business opportunity.
You know what's interesting is that I never thought I have a consulting company that I could sell my company. In the last year, I started thinking, you know, I'm not trying to sell my company. I have a long career ahead of me, but is it something that I could ever sell? Could I position it and work with a specialist to make sure that I have the right people in place and the right paperwork and records?
Definitely.
Yeah.
And that's the whole part of the exit strategy and the valuation, because it tells you what. And there are people like Pat, you know, who work with you to get the full value of your company, to help you to plan when you would be the best time to exit, how much time, where do you have holes, where are there gaps that are going to hurt you from a valuation perspective, because that's a big key, particularly with smaller businesses.
Looks like, Pat, I'll be hiring you and you can hire me.
That does work.
Yeah. So what is the key ingredient that you think makes a merger or an acquisition successful?
As I mentioned, you know, a key is on the back end with the operations. And one of the key things that I believe is culture and what it is, that piece that your friend talked about. You know, it wasn't the business that she wanted it to be, so she repurchased her business back.
Yeah.
And recently, I want to borrow some words from Tom Petro. He's a CEO of Fox Chase Bancorp, and he made an analogy, and I think it's perfect. That culture is to company as health is to the body. And if you think of it that basically, you know, culture is. I mean, a lot goes around that word of culture. That's what your company is and who it is. And it troubles me to hear when you hear people say, oh my gosh, whether they're in a larger company or a professional services like a law firm or a dental practice, and our companies are merging or being acquired, and everybody goes into fear.
You think you're going to lose your job.
Yeah.
There's going to be redundancies.
Right.
And
And instead, it should be something where people are able to look at what is it that we're trying to build here. This is a new entity. This should be a time of excitement as opposed to that, you know, demoralizing fear, because we don't like change. But there are ways to do it. And if you focus on culture and what the organization is going to become, you get rid of some of the trauma that comes with it. And along with that comes collaboration, communication, and other factors that fit into the culture realm.
okay.
Well, now, we talked about Patty's situation where the woman bought back the company because it wasn't being run well. Why would a business that is involved in an M&A acquisition decide to work with your company, Star Business Alliance, to provide that post-merger integration service? Because that really sounds like what Patty's friend was missing.
Right. Well, first of all, any M&A is financially driven. So everyone is looking at it from a financial perspective, whether the buyer's going to get something out of it, the seller's going to get something, and hopefully the entity going on is going to be a successful performing organization with the profits that meet the expectations as to what was considered in the deal. With that, you want to make sure that you have people who understand the deal, because you need to understand what the financial objectives are from the organizational perspective, and that's something that we bring to the table, is understanding, because we've been on the buy side, we've been on the sell side. But looking at that fresh new vision as another piece, so that you have employees sharing in that future and looking forward. Unified business operations with the idea of optimizing for efficient performance, because that's key. You want to have integration and not have duplicity, but you also want to make sure you keep the right people. You don't want to lose key pieces of your business because of fear of people leaving. you want to make sure your profit expectations are met. So the financial piece is throughout any type of an M&A transaction. And I think that's the piece, because there's so much focus on that. That's the part that scares people, because they don't understand it. You want to make sure you have the right talent in the right place, and that's one of the things that we work to support, because we work with the team that's there. We don't replace them. We're not coming in to replace the management team. We're coming in to shore up the team in the areas that they need to support this new ongoing entity. And we seamlessly look to bring the organization together into a very functioning performance engine where we're capitalizing on both organizations that have come into play.
How long do people usually keep you involved for that post-merger?
It really depends upon the organization. It depends upon what the infrastructure is, how much planning has gone into it, how much time, if they have an exit strategy, if they've worked with somebody from a valuation perspective. Are they
talking about an exit strategy after they just purchased it?
This is if they had an exit strategy going into the acquisition.
Right. That's
Yeah. If they had a strategy, then things may be more in place. For instance, organizationally, it could be, is the leadership the right leadership, or does the leadership need coached because the organization now has new challenges because it's a bigger organization? So it just depends upon each one, and each transaction, each deal is a end to itself. I mean, they have its own specific issues, problems, and challenges.
Okay.
Now, Georgine, you've talked to me in the past about your technology partners. Can you explain the business alliance aspect of your company?
Right. Rather than having a cookie-cutter approach and where you've got lots of people to come in, we work specifically with different partners. And as a matter of fact, I have 2 technology partners. One that deals specifically with a state-of-the-art technology that looks to alignment and that integration aspect. And they use this technology to be able to maximize the performance in all elements of the organization. I have another second technology partner who also uses state-of-the-art technology that works on the organizational effectiveness and the culture aspect, which is a really rare technology. So, and both of those then help again on that optimization and looking at the profits and the performance.
Great.
Well, I want to thank you for coming today. This was really enlightening on both of your parts, because I learned about the economy and about how to one day maybe plan to sell my company.
Great.
Yeah. So next week's special guest, if you'd like to come and view it again, is Tim Schafer. He's the president and CEO of InnoFect LLC. He's working to end infections in hospital settings. So thank you so much for joining us today with Money Matters TV. And thank you, Patricia, and thank you so much, Georgine.